Hello, my name is Nick Munger and I'm a Managing Director with Novo Advisors. Today I'm going to provide supplemental narrative to guide you through the 13-week cash flow template available on the Novo Advisors website. Before we dive in, I'd like to spend just a few minutes describing the purpose of a weekly cash forecast and how managers can use it to enhance their oversight of liquidity management and business performance. At a high level, the cash forecast is, by its name, a detailed view of the cash activity expected to take place within a business. While the income statement can provide an overall view of profitability, understanding the true cash activity taking place in the period is important in identifying any needs for working capital and capturing the exact timing of when cash will be available or perhaps needed to fund operations. Certainly, if a company is facing liquidity challenges and requests additional capital support from its lenders or other stakeholders, management should expect that a 13-week cash forecast to support that need would be requested. Alternatively, in times of stable or optimal business performance, this cash forecast still serves as a beneficial tool to benchmark expectations and monitor performance. So with that said, let's walk through this cash forecast template, and I'll describe some of the common items we see across all businesses and industries. Along the way, I'll discuss some of the specific items you may want to modify in the template to suit your specific company's needs. In the template, you'll see each week as a separate column moving left to right, ultimately with a 13-week total at the far right. Down the left side of the template, you'll notice 4 key sections. Revenue, while not a part of the cash activity in the forecast, will be the driver of forecasted cash receipts. The next section are the receipts, or cash proceeds coming into the business. Below that, we have operating disbursements, which are the primary expense line items that would be similar to the expense portion of the income statement. And finally, we have other disbursements, which are cash payments expected to be made outside of normal operations, or payments that may not necessarily show up on the income statement. So let's take it from the top. Within revenues, we've provided line items for customer revenue and other revenue. We would expect the vast majority of revenue to be revenue from customer invoices. We've left this secondary line for other revenue that can be used to capture non-recurring items and miscellaneous sources of revenue. From there, let's move down to the receipts portion. You'll want to use this section to forecast when you believe customer or other cash receipts will arrive. For instance, if you typically collect receipts from customers in 30 days, then you would want to take the revenue projected and use that revenue figure to project your collections out, probably in the next 4 to 5 weeks. For a retail business or other type of consumer business where cash or credit card transactions are common, then your revenue will likely occur in the same week as you'll receive the cash collections. Moving down to the other receipts line item, this is meant to capture, as with the revenue above, non-recurring or miscellaneous receipts. It could include rental income, rebates, proceeds from the sale of fixed assets or equipment, and other non-recurring revenue streams resulting in collections. Now that we've covered the revenue and corresponding receipts portion of the forecast, let's move on to the cost side of the equation. This is arguably the most valuable component of the forecast, as the exercise allows us to map out the detailed timing when our obligations are due to be paid. Referring back to the difference between an income statement and cash forecast, an income statement includes numerous expenses that are allocated evenly across a month or a year, but in reality, the cash outlay for that cost occurs at a precise due date or point in time. When you look at the cost base in total, you can see how GAAP-based expenses on your income statement and the true cash payment required could look very different. Let's start with a component common to every company: payroll. We've opted to include 3 distinct sections within payroll because the frequency in which these items are paid can be quite different, and it's often easier to view them and plan them individually. Our first line item is wages. You'll want to project this out based on your specific payroll cycles. You may have hourly employees who get paid weekly, salaried employees who get paid biweekly, or some combination of each. Don't forget to include the grossed up wages, which include employee withholdings and corporate payroll taxes that are owed. Next, we have employee benefits. These should include items such as 401k contributions, employee healthcare premium or claims payments, or other benefits paid for outside of normal payroll operations. Third in this section are commissions, or you might think of them as bonuses. The line item is meant to capture employee compensation above and beyond recurring payroll. Perhaps you pay monthly commissions, holiday bonuses, or other performance-related pieces to some of your employees. Again, don't forget to include this figure with corporate taxes that are owed. Next, we'll move into the operating expenses section. The line items shown here can be customized for what suits your business, but we've included the most common categories that we see across our clients. As mentioned before, this section is where you'll start to see some stark contrasts between what is reported as expense on your income statement versus what's due to be paid in the period. The first line item is inventory purchases, which is intended to capture your cost of goods sold. Similar to how we forecasted revenue and receipts above, here we want to factor in payment terms that we have from vendors. So for instance, if you purchase $100,000 of materials over the course of a month and you have 30-day terms, you should expect to pay $100,000 out in the following month, regardless of when those cost of goods sold are expensed on your income statement. Secondly, we have rent. Pretty straightforward here. You should schedule out your rent payment obligations in the proper weeks that they are due. Third is insurance. Insurance should include business policies such as liability, D&O, auto, property, and the like. Essentially all insurance policies outside of employee health care. While these are often expenses that are straight-lined throughout the year, you should map out when the actual premium payments are due. Some could be quarterly, annually, or monthly. Varies depending on the policy. Utilities, fourth, are often due at periodic points throughout the month. Novo typically uses a weekly average of a monthly total to forecast payments, understanding that some weeks will have lighter activity than expected, and in other weeks will incur some overages. But all in all, you should see pretty consistent activity across your utilities line item. Fifth is repairs and maintenance. These costs will fluctuate and can be unpredictable in nature at times, but using a historical average is a good place to start. If you begin to see actual results deviate significantly from your forecast, that can be a good opportunity to identify faulty equipment in need of replacement or other red flags that deserve your operating attention. Sixth is software and technology. This is another key item where your cash outlay will deviate significantly from your income statement expense. These services are often billed as subscriptions on a monthly, quarterly, or annual basis. Examples here can include your ERP provider, a CRM that's used by your sales team, or financial accounting system that's used to maintain your books and records. Taking the step of mapping out when these subscription services are due can help you identify your large, sort of lumpy payments that are required in the near term, or perhaps prompt a discussion with your vendors to institute a payment plan to spread that commitment out over time. Seventh is advertising and marketing. This is similar to the technology item above, but it's intended to cover discretionary spend on various marketing services. You should follow the same steps as we mentioned for the technology item above, and you may identify some opportunities to remove some redundant services along the way. Eighth is travel and entertainment. This should include budgets that are allocated for your sales team for their outside sales efforts, holiday parties, corporate events, and other T&E related functions. Ninth is professional fees. These should include outside parties that are contracted to perform legal and financial work in the course of your normal business. Payments to lawyers who handle affairs for the business, tax, and audit professionals are examples of vendors that would fall into this category. 10th is taxes. Taxes should include any tax obligations outside of payroll. For example, property taxes or sales and use tax. And finally, we've left some placeholders to add in line items that may be custom for your business. Another good strategy here is to have maybe an other bucket. Think of it as a nominal amount of funds set aside for the proverbial rainy day or unexpected need that may arise. Now that we've covered the operating disbursements, you'll see that we arrive at a line called operating cash flow, which indicates the cash generated or used by normal business operations. The next section is to capture those payments that may not be included on the income statement. We've titled this section Other Disbursements. First in this category, we'll address capital expenditures. This line item should be any capital outlays for renovations, repairs, etc. that would get capitalized on the balance sheet. We're making the assumption here that routine maintenance costs are captured in the repairs and maintenance section up above. Next, we have debt payments. While debt interest is captured on the income statement, we opt to move all debt service payments below the operating cash flow line to separate them from business operations. You should break out your interest owed on debt and then layer in any debt principal payments according to the terms of your loan or mortgage agreements. The last line is other extraordinary items, which is intended to include extraordinary expenses outside of the normal course of business and are non-recurring in nature. Examples of these expenses can vary widely, but just some simple examples are legal proceeding settlement payments, commissions on sale of real estate or equipment, restructuring related expenses, perhaps expenses related to M&A activity, or other things that stand out as unique expenses to the business. And that includes all of the inputs necessary to determine your business's net free cash flow. At this point, you'll be able to identify the exact points in time in which you expect to see cash generated or perhaps to see a cash need. Keep in mind, your business might generate positive net income over the 13-week period, but after you layer in all of the monthly rent obligations, annual subscriptions, the timing of software payments and insurance policy payments, you may actually identify that despite positive net income over the period, the company does have a need for working capital at certain points within that 13-week period. We hope you found this template and tutorial to be informative in helping you construct a basic cash forecast that you can use to enhance your management of the business and communicate effectively to your stakeholders. Thanks for watching.